Welcome to the AFS Best Practices Leadership Webinar. Thank you for joining us today. Our topic is Pricing Fundamentals, a review of the first quarter commercial lending landscape. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Jeremy Charlson, and Rob Lynch from our Business Intelligence team. Before we get started, there are just a few items so you know how to participate in today's event. We do have a poll today, so we would encourage you to participate in the poll. Your responses are anonymous and won't be seen by the attendees. We do encourage questions. Please use the Q&A feature to ask your questions. We will leave time at the end of our prepared remarks to answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you again for joining us. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, Pricing Fundamentals, a review of the first quarter 2021 commercial lending landscape. We here at AFS know how busy you are and really appreciate you taking the time to join us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our Pricing Trends monthly newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. As we move to slide 4, today, we will be reviewing results through the first quarter 2021 with a focus on loan growth, pricing and fees, and risk and return. A quick housekeeping note. Unless explicitly noted, all charts in this presentation exclude the Paycheck Protection Program, PPP loans. To get started, we move to slide 6. Looking at the broader financial market landscape, March delivered encouraging news on the economic front. The GDP results for the first quarter were released last week, and the initial estimate set 1Q GDP at 6.4%. That's one of the strongest quarterly averages in years, and several economists expect the momentum to build throughout 2021 due to the massive fiscal support already in place and with more likely on the horizon. Furthermore, job growth accelerated throughout the quarter, with over 900,000 jobs created in the month of March alone. From an earnings standpoint, banks have taken note of these favorable economic conditions and have begun releasing loan loss reserves in anticipation of more improvements ahead. However, based on earnings calls, the outlook for commercial loan growth is mixed among the banks. An American Banker article reported that while some banks expect commercial loan growth to pick up in the second half of the year, others pointed out that companies have been slow to take on new debt to increase their inventories. As we will see on the slides to follow, that elusive rebound in commercial lending has not yet materialized. Before we look at the trends in commercial loan growth, we thought it would be interesting to perhaps take a sneak peek at what commercial loan growth may look like later this year by looking at today's current pipeline activity. So with your help, we have a poll question asking, how would you best categorize commercial loan pipeline activity at your bank relative to 6 months ago? If you feel it's up 10% or more, that would be a strong rating. Modest would be up low to mid single digits. And if you feel that it's basically the same or possibly even lower, that would be a weak rating. So if you would kindly make your selection, we'll give you a little bit to do that.
All right, Don, I think we have our results, so I will go ahead and close the poll and share the results.
Okay, so it looks like the majority thinks it's up low to mid single digits, and strong and weak basically was neck and neck on a tie. So thank you for those responses. We'll see how this plays out in the coming months of 2021. Next on slide 8, we look at the high-level trend in commercial loan growth. Here we show annualized month-over-month growth rates for C&I loans in blue and commercial real estate loans in orange. Note that this chart includes loans made as part of the Paycheck Protection Program. To say that 2020 was a volatile year for C&I loan growth would be an understatement. C&I loan balances surged last spring due to customers drawing heavily on lines of credit at the start of the pandemic and the launch of the PPP program shortly thereafter. However, this upswing in loan growth quickly reversed course in the second half of 2020. An S&P Global article reported that many corporate borrowers used bond proceeds to pay down their bank loans. Interestingly, CRE lending continued at a steady pace throughout 2020, although lending to new non-residential properties slowed during the year. This sluggishness continued into the first quarter of this year, which is spotlighted on the right side of this slide. C&I balances experienced a temporary lift in February, thanks to the relaunch of the PPP program, although the program's impact on loan growth moderated in March. Meanwhile, CRE balances contracted in February and again in March. Hopefully, the momentum will shift later this year as the economy normalizes and business borrowers regain their footing. As we move to slide 9, we examine loan balances this quarter relative to where they stood before the pandemic. The chart here compares balances in each month to a December 2019 baseline, which is indexed at 100. So a value above or below 100 indicates that balances in the month were X% higher or lower than they were in December 2019. As you can see, when we include PPP loans, the value in March 2021 is 108, meaning that total outstandings in March were 8% higher when compared to the level seen before the pandemic. It is a much different story when we remove PPP loans from the mix. Excluding the PPP loans, the value in March 2021 was 98.9, or 1.1% lower than December 19. To put it another way, non-PPP loan balances have yet to make up for the lost ground in 2020. The drivers of this trend are numerous and include an increase in paydowns in the second half of 2020, borrower uncertainty about future economic conditions, and historically low line of credit utilization rates. Next on slide 10, the 2020 downturn in commercial lending was reflected broadly across the deal size spectrum. Here we examine quarter-over-quarter balance growth rates by ranges of commitment size. We can see the spike in balance growth last March, especially in the larger end of the market. Since then, growth in total commercial loan outstandings has decreased in every consecutive quarter, although the rate of decline has moderated recently. In 1Q21, we did see a small balance increase in the greater than $25 million range. However, This increase was offset by declines across the other deal size ranges. Moving to slide 11, we continue to observe a wide range of results in loan growth when segmented by geographic location. On this slide, we pinpoint the top 5 and bottom 5 states for commercial loan growth quarter over quarter, with the ranking for bilateral loans on the left and participations on the right. We saw that balances for both bilateral loans and participations were down across the majority of states. However, there were a few states where growth this past quarter was fairly robust. For bilateral loans, we saw pockets of growth in the Southwest, specifically in Texas and Colorado. From an industry standpoint, the increase for Texas was heavily concentrated in the utility sector, more specifically in the electric power generation, transmission, and distribution subsector. We also noticed that 3 of the top 5 states for bilateral loans, Georgia, Florida, and California, ranked among the lowest states for participations, shown on the right. For participations, Tennessee led balance growth in the first quarter, with increases seen in the healthcare sector, focusing on nursing and residential care facilities, hospitals, and ambulatory healthcare services. Tennessee also saw an increase in the gasoline station subsector within the retail trade sector. Only 3 other states were up quarter over quarter in March for participations. They were Ohio, North Carolina, and Massachusetts. As we move to slide 12, we look at GDP and loan growth. In terms of the drivers of commercial loan growth, GDP is one of the leading indicators to watch. One development over the last several years has been the concentration of economic activity in the largest metros of the country. This has resulted in a bifurcation in loan growth trends, in which lending has become increasingly concentrated in the economic hubs of the country. On this chart, we aggregated the top 10 core-based statistical areas, or CBSAs, in terms of real GDP and examined loan growth for this group versus all other geographic areas. While loan growth slowed broadly across the country in 2020, the downtrend was much more pronounced for the areas outside of the top 10 CBSAs. As of March, total balances for all other geographic areas were lower than the pre-pandemic level, down 3.3%. Conversely, the pace of balance growth accelerated in March for the top 10 CBSAs, with balances for this group 2% higher than the pre-pandemic level. It will be interesting to see how these trends evolve in the coming months and years. COVID-19 accelerated many demographic and economic shifts that were already underway, including movement out of the country's most expensive cities. Perhaps commercial loan growth will pick up outside of the top 10 CBSAs if people continue to migrate out of urban centers and into more suburban and rural areas. In addition to geographic location, industry sector is one of the key drivers of commercial loan growth. On slide 13, we examine the industry rankings for balance growth, with bilateral loans shown on the left and participations on the right. Food, beverage, and apparel manufacturing led bilateral loan growth over the most recent quarter, where significant growth was seen in Missouri, Washington, and Colorado. Third on this ranking is finance and insurance. This sector is usually a meaningful driver for commercial loan growth, and that trend continued throughout the pandemic. We saw 1Q21 balances increase significantly in California and New York. Interestingly, while finance and insurance was a leading sector for bilateral balance growth, this industry ranked among the lowest sectors for participated balance growth. For participations on the right, the highest ranking industry in the first quarter was information, where we saw higher balances in Dallas-Fort Worth and Boston. The utility sector was next, with Columbus, Ohio, and Oklahoma City posting higher balances. Information and utilities also tend to rank favorably relative to various measures of credit risk, such as probability of default. Note that the largest subsector with information is telecommunications, and this segment has weathered the pandemic quite well. On the next slide, we look at line utilization. Much of the recent volatility in loan growth can be explained by examining trends in line of credit utilization. On this slide, we illustrate commercial line of credit utilization by deal size, with bilateral loans on the left and trends again on the right. Trends for participations on the right. Utilization spiked last March when commercial borrowers, mainly larger end customers, drew down lines of credit to shore up cash and brace for disruptions at the onset of the pandemic. Following the spike in 1Q20, commercial line of credit utilization declined noticeably across deal size ranges, a trend that was consistent between bilateral loans and participations. For every segment illustrated here, line utilization in March 21 was below the pre-pandemic average. These charts help explain the subdued level of balance growth that we have seen in recent months. In terms of why utilization has been so low recently, there are a number of factors at play. We've heard that some larger and corporate borrowers have turned to capital markets to refinance their debt and pay down bank loans. In addition, many companies have been slow to take on new debt to increase their inventories, which has had an adverse effect on bank lending. Hopefully, as the economy continues to improve, we will begin to see higher levels of business confidence in the form of increased line of credit utilization. On the next slide, we look at line utilization across industries. In our last webcast, we analyzed what we called COVID-sensitive industries, a collection of subsectors that bore the first order effects of the pandemic. On the far left, we have the trend for the COVID-sensitive industries as a group, followed by the trends for the individual subsectors. The peaks and valleys that we see in line utilization at the all industry grouping are magnified for the COVID-sensitive industries. Compared with the all industry average, line utilization for the COVID-sensitive industries experienced a large increase last March, followed by a steep downtrend in the subsequent quarters. Across the individual subsectors, oil and gas, followed by restaurants and bars, displayed the highest utilization rates as of March of this year. Two COVID-sensitive subsectors now reporting utilization rates below the all industry average are healthcare facilities and non-essential retail. Healthcare might surprise you given its importance in fighting the pandemic, but we know that many hospitals and doctors' offices had to postpone elective surgeries in 2020, which affected their profit margin and increased their chances of experiencing credit distress. Next, on slide 16, we look at the trend of new and renewed loan volume. As illustrated by the chart on the left, volume for both new and renewed deals increased in February and again in March. It's worth noting that the new volume in March was well above the levels seen during much of 2020. Aggregate new and renewed volume was down in March when compared to March 2020. For all of 1Q21, new volume was beneath the level seen in 1Q20. This comparison is shown on the chart on the right. Renewed volume in the quarter was also down from the level seen a year ago, although when compared with new volume, the decline for renewals was modest. Given all the volatility over the last year, we examined how the composition of new and renewed volume varied quarter over quarter. On slide 17, we plot the industry distribution of new and renewed volume in 1Q20 as the blue series and 1Q21 as the orange series. Presumably, industries where the relative amount of volume has increased will most likely be the sectors that lead loan growth as we emerge from the pandemic. The largest changes we observed were for the finance and insurance related industries, the three subsectors we highlighted on the far left on this chart. The types of activity and borrowers found within these industries are varied. These industries represent, among other things, non-bank lenders, mortgage warehouses, private equity, and hedge funds. Prior to the pandemic, finance and insurance consistently ranked as one of the fastest growing industries for commercial loan growth. It appears that, if anything, the pandemic has deepened the connection between the commercial loan market and these financial intermediaries. Conversely, the percentage of new and renewed volume decreased year over year for the professional services industry, highlighted around the middle of the graph. This industry includes bookkeeping services, architecture and design firms, and engineering companies. Professional services also was one of the industries to receive a great deal of PPP assistance, which may help to explain the decline in conventional C&I volume for this sector. Okay, that covers our review of loan growth for the first quarter 2021. Next, we will examine how loan pricing has varied through the first quarter. With that said, I'll turn it over to Rob Lynch for an analysis of commercial loan pricing and fees. Rob?
Thank you, Don. Good afternoon, everyone. In looking at pricing for new and renewed loans, we see that there was very little movement in the first quarter. The chart on the left shows interest rates for new and renewed bilateral loans, excluding PPP. And since April of 2020, rates have been in a narrow range. The chart on the right shows a similar picture for participations, where there were more modest movements over that same time period. In March 2021, interest rates for both new and renewed participations decreased to some of the lowest levels seen in the last year. And while interest rates on loans are not moving all that much, it is important to note that the rate on the 10-year Treasury increased over the last quarter and is now slightly above where it was before the start of the pandemic. And some analysts are seeing this as a sign that the economy is strengthening. On the next slide, a breakout of loans by type over the last year. With the sunset of LIBOR on the horizon, we wanted to see what other indexes are being used. And over the last year, we can see that the use of LIBOR decreased by just under 3%, while prime has decreased slightly and fixed rate loans have increased. Alternative rates like SOFR and Ameribor are starting to be used, although not at a level where it shows up in this chart. We will continue to watch this over the coming months and report any findings that we find. On the next slide, we take this a little further, and we take a look at some specific industries where the use of LIBOR was more prevalent. The top chart shows the index composition from the first quarter of 2020. You can see that for each of these industry segments, LIBOR makes up a significant amount of the balances. The bottom chart shows the same industry segments for the first quarter 2021, and the difference in LIBOR originations is quite dramatic. The accommodation sector showed the most movement away from LIBOR, with fixed-rate loans being the primary alternative. In all of these sectors, the use of fixed-rate loans was the most often used alternative, with the exception of oil and gas extraction. The low interest rate environment has surely made fixed-rate loans more attractive to borrowers. And as LIBOR sunsets, we do expect that SOFR, Ameribor, and other alternative rates will be used more widely. Next, we look at interest rates by type and by industry for the first quarter. On this chart, each bar represents the interest rate for a unique index used in the industry. The mining and transportation sector shows the highest interest rate across all types. And additionally, prime-based loans have the highest interest rate across all industry sectors. This is especially pronounced in the healthcare, manufacturing, and retail and wholesale trade sectors. LIBOR and other floating rates were generally the lowest rates in each industry. Turning now to fees, this next slide shows that fee incidence in the left-hand chart increased for renewed loans and held steady for new loans over the quarter. Compared to last March, fee incidence for new loans is sharply lower, while fee incidence on renewals has decreased slightly. Fee level in the right-hand chart increased for both new and renewed loans in March after a dip in February. Fee levels on renewals were slightly above those seen a year ago, while new loans were slightly below those from last year. On the next slide, we can see that fee incidence in the chart on the left for most industries did not change much in the quarter, with the exception of mining and transportation showing an increase. When looking at fee level on the right-hand chart, manufacturing had the largest increase over the quarter, followed by mining and transportation, while retail and wholesale trade saw a decline. That concludes the pricing and fees section, and next, Jeremy Chalson will cover risk and return. Jeremy?
Okay, thanks, Rob. So what we'd like to do now is round out the analysis with an examination of commercial loan credit risk and loan structure. And it's really amazing to think how far we've come versus the first quarter of last year. A year ago, banks were rapidly building up loan loss reserves in anticipation of a surge in defaults. By comparison, this spring, banks are actually releasing reserves as the economy and the economic recovery take shape. Now, with a full year of the pandemic in our rearview mirror, we can see how government stimulus and other actions like loan modifications and payment deferrals have helped to keep charge-offs at bay. The chart you see here illustrates the quarterly charge-off rates on C&I loans in red, along with the long-term historical average as the dotted black line. Now, charge-offs did increase in 2020. You can see in 2Q20, which we've highlighted by that gray bar on the right. In 2Q20, the charge-off rate climbed to 0.59%, which was the highest rate that we've seen over the latest 5-year period. But still, this reading was low compared with the level of charge-offs that were recorded during the previous recession. And at no point in 2020 did the charge-off rate exceed the long-term historical average. Heading into 2021, C&I charge-offs were trending downwards. And while the 1Q figure wasn't ready in time for this webinar, several of the banks that we spoke to indicated that charge-offs remained low through the first quarter. In terms of credit quality, we're not in the clear though just yet. We recently surveyed the banks about how many of their commercial loans were still deferred, and 11% of respondents said that at least 3% of their commercial loans still had payment deferrals associated with them. It could be that the extensive assistance extended to commercial borrowers has camouflaged the true level of problem loans on banks' balance sheets. One still and somewhat troubling trend is that the weighted average probability of default remains elevated relative to the pre-pandemic average. We presented this metric two ways on this chart, one representing all commercial loans, which is the blue series, and more specifically that excludes the Paycheck Protection Program loans. And then we have the orange series, which is just based on the accruing loans in the database. And even when we just focus on the accruing subset, default projections in March were well above where they stood a year ago. Now, we know that many borrowers in high impact industries like hotels and airlines, among others, were downgraded last year at the peak of the crisis. It will take some time for borrowers in these sectors to regain their footing. And I imagine that banks will need to see several months of decent cash flow before reversing some of these downgrades. The good news is that we are seeing some signs of improvement for several of the industries that bore the first order effects of the pandemic. The chart here is the trend in default ratings for several high impact industries. So sectors like accommodation, air transportation, which is your airlines, and oil and gas. So let's focus for a moment on air transportation, which is presented third from the left. From December 2019 to December 2020, the weighted average probability of default for this industry more than doubled. This measure did edge a little bit lower in January and again in February of the current year, and then it improved significantly in March. And we're seeing similar improvements for other high impact industries this month. So sectors like oil and gas and transportation manufacturing, both of which we've also circled on this particular graph. So hopefully these improvements will continue and strengthen in the coming months as more vaccinations are delivered and people become more confident about traveling again. So given the volatility in credit risk over the last year, we've received many questions about loan structure and collateral. One factor that dictates the level of loan losses is the strength of the underlying collateral and the level of unsecured loans in the portfolio. Here we illustrate the percentage of unsecured loan balances relative to total outstandings. You'll notice that in March of this year, or March of last year rather, unsecured loans as a fraction of total loans spiked. You can see it went from about 16.4% in February, as high as a ratio of 18.5% in March of last year. Now, Don had referenced the increase in line utilization that we observed during this time frame. And what happened here is that borrowers, mainly syndicated borrowers, tapped lines of credit to shore up cash at the onset of the pandemic. And since many of these borrowers that were drawing down on lines of credit were syndicated, and since many of these syndicated deals were unsecured, what happened was the unsecured ratio increased around that time frame. As utilization for these unsecured syndicated borrowers declined, so too did the unsecured rate. You can see it drops off in the months that followed. And in recent months, looking at 4Q and 1Q of this year, the unsecured loan ratio is held pretty steady. Interestingly, unsecured balances actually ticked up in March for a couple of industries that have been adversely impacted by the pandemic. Typically, unsecured lending is more prevalent in what you might call low-risk industries, so sectors like utilities, for example. You can see here on this chart, utilities, it's pictured second from the left. The unsecured ratio for that industry is nearly 50%, so nearly half the balances in utilities are unsecured as of the most recent month. Now, one sector to note here is motion picture and sound industries, which is pictured in about the middle of the graph. We highlighted it with one of those orange circles there. This sector includes things like motion picture production as well as movie theaters. So a lot of the theaters had to close down this year due to the pandemic and some of the measures to control the spread. It's interesting that for this industry, the unsecured ratio increased from 30% in December to a ratio of 33% in March. And that seems like a fairly high level of unsecured loans for an industry that faced so many challenges over the last year. Although it's worth noting that the March reading of about 33% really isn't too far off from the pre-pandemic average. We see a similar level of unsecured lending in the water transportation industry, which is shown second from the right. Water transportation includes things like cruise lines, among other types of companies. As of March, unsecured loans comprised more than a third of the total outstandings in the water transportation industry. That's a much higher level than we saw compared with the pre-pandemic average. And I believe what happened here was that unsecured syndicated borrowers in this sector drew heavily on lines of credit at the start of the pandemic. And many of these draws have not yet been repaid, which has kept the unsecured ratio elevated for this particular industry. One of the key events last spring was the sharp rise in credit spreads in response to all the uncertainty surrounding the pandemic. In fact, at one point, the credit spread for BBB corporate bonds spiked to nearly 5%, which was one of the most dramatic increases we've seen in a long, long time. Now, the Fed stepped in to stabilize credit markets, and in the months that followed, credit spreads did return to what you might call more normal levels. In the commercial lending space, spreads on new renewed commercial loans widened since the beginning of the pandemic, although we didn't observe quite the same level of volatility here as we saw in the bond market. The chart on this slide plots the weighted average LIBOR equivalent spread as the blue line versus the weighted average obligor risk rating as the orange series. Now, it may seem a little bit outdated to present a LIBOR equivalent spread, given the fact that the end of this index is rapidly approaching. We should note that AFS has been at the forefront of the LIBOR transition project, and our business intelligence department is considering several new ways to represent spread pricing. That being said, the best replacement index is still a matter of debate, and as Rob showed a few slides ago, the majority of new renewed commercial loan volume in the first quarter was still tied to the LIBOR index. I think what's most interesting here on this chart is that since 4Q19, the two time series here have closely tracked one another. So the increase and the volatility in the weighted average risk rating follows very closely the trend in the weighted average LIBOR equivalent spread. Specifically, if you look in 2Q20 and 3Q20, we saw a really large increase in credit risk. And commensurately, we also saw a large rise in the weighted average LIBOR equivalent spread. I think it's safe to say that the balance between risk and return was maintained during the height of the pandemic in 2020. In the first quarter of 2021, the weighted average risk rating for new renewed commercial loans improved significantly, which bodes well for the credit outlook for the rest of this year. Commensurately, the average spread also declined in the quarter, although both metrics remain above the pre-pandemic averages in 4Q19. On the next slide, we can see the difference in spread between investment grade and non-investment grade loans. Spreads on a LIBOR equivalent basis widened in 2020 for both investment grade and non-investment grade loans, although the increase was more pronounced for the non-investment grade segment. In the first quarter of 2021, the average spread for investment grade loans fell to a level nearly identical to the pre-pandemic average. It was about 1.78%, which was nearly identical to the average we saw in the fourth quarter of 2019. Conversely, the average spread for non-investment grade loans was 27 basis points higher than the reading prior to the pandemic. So basically, for non-investment grade loans, pricing standards are still a little bit tight compared with the pricing environment seen a little over a year ago. Now, a neat way to visualize pricing trends in the market is to examine the difference between these two lines. That measure, the difference in spread between an investment grade loan and a non-investment grade loan, is shown on the right-hand graph of this slide. Generally speaking, this difference rises during periods when banks tighten standards on commercial loans. And fittingly, this measure spiked in 1Q20 and has remained somewhat elevated compared to the pre-pandemic levels. The largest difference was observed in 1Q20, the largest difference rather was observed in the first quarter of this year, 1Q21, which again suggests that pricing standards are still somewhat tight in the non-investment grade segment of the commercial loan market. Of course, risk return trends can and do vary by industry sector. The bubble chart you see here plots the 10 largest NAICS subsectors in terms of new renewed volume on this risk return matrix. So on this chart, the weighted average risk rating for each industry is depicted by the horizontal axes, and then the weighted average LIBOR equivalent spread is provided by the y-axis, or the vertical axes here. The black quadrant lines are the averages for the total commercial loan markets. We can group the sectors into good, bad, and neutral quadrants. It's always fascinating to us that at the subsector level, returns are not always well correlated with credit risk. For example, non-durable wholesalers, which is the purple bubble in the bottom right quadrant, displays a worse than average risk rating, as well as a lower than average weighted average LIBOR equivalent spread. Earlier in the webcast, Don had pointed out that securities and commodities, that finance and insurance industry, had grown quite a bit in terms of new renewed volume over the last year. And one reason why bank lending may have increased in this sector is because it displays a fairly attractive risk and return profile. You can see that the placement of this subsector, the dark blue bubble on this chart, is in the best quadrant in the top left, where it has a above average spread and a better than average risk rating. Whenever we onboard a new bank to the AFS pricing dashboard, we always like to look at their sector holdings across this risk and return plane. Doing so helps reveal the sectors contributing most favorably to their overall spread profile. So I think we can safely say that the conditions in the first quarter of 2021 are far better than they were compared with the volatility and the uncertainty that we experienced in the first quarter of the prior year. While economic conditions are rapidly improving, that rebound in commercial lending remains elusive. We're still not seeing much of an uptick in total balances. In particular, what's a little bit troubling is that line utilization remains very, very low. Line utilization across all deal size segments is still below the pre-pandemic averages. Hopefully that'll pick up in the months that follow. I know some banks are pretty bullish on loan growth, but as of now, that rebound in commercial lending remains quite elusive. From a pricing perspective, LIBOR is still the predominant index for commercial loans. As Rob pointed out, we are seeing migration to some other rates, mainly fixed rate lending did increase year over year. It'll be interesting to see how this plays out, whether Ameribor or some other indices start to take a greater share of the volume. But right now, LIBOR is still representing most of the volume that we're seeing in the commercial lending space. We do continue to point out that fees are an unrealized revenue opportunity for many banks. We know that right now, the pricing environment is still very challenging, but there are some opportunities out there to collect on fees. Unfortunately, in March, the results did show that total market fee penetration decreased year over year. That fee incidence metric was down. So we're still seeing some pressure there on the fee side as well. Conversely, some good news is that commercial loan credit quality has weathered the pandemic very well. Charge-offs at no point in 2020 exceeded the long-term historical average. They've actually been trending downwards as of the most recent quarters. Some of the default outlooks, the default ratings we're seeing on loans are still a little bit high, but many of the banks that we spoke to over the last couple of weeks are very optimistic about credit. They expect many of the downgrades that took place in problem industries to reverse at some point this year, hopefully in 2Q. Also as well, commercial spread pricing is generally commensurate with credit quality. So from a risk return perspective, things are looking pretty strong as well. When risk rose in 2020, so too did spreads. So at least on the spread side, banks are being compensated for some of the deteriorations in credit quality that we saw overall in the prior year. We really want to thank you for taking the time today to join us for this webinar, and a special thanks to all the banks that participate in the AFS pricing dashboard service. It's been an interesting year, a very interesting quarter. Hopefully we'll continue to see improvements in the months that follow. As always, we're always here to answer any questions you might have about commercial lending. Our contact information is listed here on this slide. We love the dialogue with the banks. So if you have any questions, Renee, I think now we'll take some time to see if any came through the chat or the questions menu. And if not, please feel free to reach out to us via our contact information here. Again, really appreciate your time. And Renee, let's see if there's any questions on the line.
So Jeremy, we do have one question that's come in. So the question is, what sectors do you see leading loan growth as we emerge from the recession?
Yeah, that's a great question. And I think one area or one industry that we're really paying a lot of attention to is what you might call some green industries or green lending. You know, you hear all the time about ESG becoming a much bigger topic and factor in the banking industry. I would imagine that a lot of things like renewable energy and any other green related sectors are going to see a pickup in loan growth in the months that follow, especially under the new administration. Incidentally, we actually highlighted green lending in a webcast a little while ago. The Bureau of Labor Statistics puts out a great pamphlet where they say, here's a list of industries that typically have a lot of green and sustainable lending as part of them. And what we saw is that actually loans in those sectors, these quote unquote green loans, tended to have very favorable risk return profiles. So I would really keep our eyes out for green lending and green industries as we emerge from this recession.
Thanks, Jeremy. It looks like we have one more question so far, and that question is, there was a slide where default ratings in March were still elevated versus the pre-pandemic average. Any insight to how credit quality changed in April?
Yeah, another good question, and I think that's referring to the chart you see here on slide 27, where the weighted average PD is still somewhat elevated. I think it's going to take a little bit of time to kind of work through the downgrades that took place earlier in the year. If you have listened to some of the bank earnings calls over the past couple of weeks, a lot of banks are pretty bullish on credit, pretty optimistic about credit. We've spoken to a lot of the clients that participate in the AFS pricing dashboard, and they echoed that sentiment. There were a lot of downgrades that took place in industries like oil and gas and hotels. They might still be under some pressure for the months that follow, but I would expect a lot of the downgrades that took place in some other sectors will reverse in the months that follow. And for some of the banks that we spoke to, they actually said that credit quality did improve in April. So when we share the results in Q2 in a few months from now, I would certainly expect this trend to be heading in the right direction.
Great, thanks, Jeremy. Well, that looks like all our questions for today. Again, we'd like to thank everyone for attending, and we will be sending out an email tomorrow with a link for this presentation, as well as the ability to share the recording or listen to it again. Also, you can see we have some upcoming webinars here. You'll find those on our website, or you can just click this register now, and you'll be able to participate in these upcoming webinars. Again, thank you all very much and have a nice day.
Thank you all.